Hello everyone. Welcome back. Today, we've got some crucial news you don't want to miss. Let's dive right into the top financial headlines and break down what's happening. Today, the U.S. Labor Department released the September non-farm payroll report, a key economic indicator that garners significant attention from both professionals and the general public. Employment is a crucial aspect of economic health. With jobs come income, and with income comes consumption, the foundation of any economy. In contrast, employment issues tend to be a secondary concern in China's macroeconomic data, while in the US and other Western countries, it remains the top economic priority. According to a report from the Wall Street Journal, the employment numbers exceeded expectations, with the unemployment rate dropping to 4.1%. The data revealed that the US added 254,000 jobs in September, marking the largest increase in 6 months. Additionally, the annual wage growth rose to 4%, the highest increase seen in 5 months. These figures surpassed forecasts from various institutions and economists, with no predictions even approaching the scale of today's data. This significant rise in employment naturally led to a notable decrease in the unemployment rate. For context, last month's job increase was around 170,000, making the 254,000 figure a remarkable jump. While there may have been statistical anomalies last month, today's data has generally been well received by the market. Interestingly, the market's reaction to this data marks a shift from the past year's logic. Historically, when non-farm payroll data was strong, Wall Street would react negatively, fearing that good news could deter the Federal Reserve from cutting rates. Conversely, poor data would often elicit cheers, as it indicated a potential rate cut. However, today's impressive figures reflect a new sentiment on Wall Street: good data is simply good data. Why this change in market logic? As discussed last week, Wall Street's perception of the US economy is undergoing a revolutionary shift. Traders are moving away from concerns about a potential recession. The topic of recession has largely been abandoned. Some analysts, including those from Morgan Stanley, believe that the economy is growing robustly, dismissing the notions of a soft or hard landing. Following the release of the Labor Department's data, both J.P. Morgan and Bank of America quickly directed the market's focus. According to the Wall Street Journal, economists at these banks now expect a more gradual approach to easing, predicting that the Fed will lower rates by 25 basis points in November rather than the previously anticipated 50 basis points. This reasoning reflects a departure from inflation-centric rate policy judgments, indicating that the banks believe inflation issues are largely resolved. Thus, even with a strong labor market, there's no pressing need to clamp down on growth. As I've suggested before, the immediate reactions to major data releases from the US markets or investment banks can often be emotional. It's essential for Wall Street to digest this data and form a consensus, which may take until next Tuesday or Wednesday to develop. So, when faced with significant data, particularly surprising figures, it's important to avoid jumping to conclusions too quickly. However, the subtle shift in how the market evaluates US macroeconomic data is something worth paying attention to. The second news: a recent report from the Washington Post reveals that during recent attacks, Iran fired 200 ballistic missiles at Israel, with at least 23 successfully hitting military targets. On Tuesday, Iran's missile strikes saw a number of projectiles bypass Israel's air defense systems, impacting at least 3 military and intelligence locations. The Washington Post has verified several videos showing that 20 missiles struck the Nevatim air base in southern Israel, while 3 others targeted the Tel base in central Israel. Additionally, other footage indicates that at least 2 missiles landed near the headquarters of the Mossad intelligence agency. This report highlights a critical aspect of Israel's air defense capabilities, indicating that they were unable to fully intercept or prevent the Iranian strikes. It also underscores Iran's ongoing military capabilities, despite Israeli efforts to downplay this information. Therefore, it is essential not to underestimate Iran's military strength in this evolving situation. The third news also comes from the Washington Post: EU nations must recognize legal gender changes across bloc, top court rules. A significant ruling from the European Court of Justice has become the headline political news across major international media outlets. The case involves an individual with dual British and Romanian nationality, who was registered as female at birth in Romania, later immigrated to the UK, and transitioned to male. On Friday, the court ruled that every member state of the European Union must recognize official changes to gender identity obtained elsewhere within the 27-member political and economic bloc. This decision means that Romania, which does not acknowledge the individual's transition, must accept that he is legally recognized as male following surgery in the UK. This situation highlights Romania's relatively conservative stance compared to other EU countries, particularly when compared to more liberal Western European nations. The court's ruling essentially mandates that Romania, which maintains a traditional viewpoint, cannot refuse to acknowledge the individual's gender identity change. Some may question the relevance of this ruling given that the individual was originally Romanian but is now living in the UK, which is no longer an EU member. However, the court clarified that the case was initiated before Brexit, and therefore it still falls under the jurisdiction of the European Court of Justice, as the lawsuit was filed while the UK was part of the EU. From my perspective, this ruling reflects a significant shift in societal attitudes toward gender identity. While some people may be accepting of these changes, others may struggle to come to terms with them. It's uncertain whether this change is reversible or not. If it is irreversible, we may need to not only accept it, but also support it. If it is reversible, there may be room for differing opinions. I invite everyone to share their thoughts on this topic in the comments below. Today's fourth news comes from Bloomberg. Temasek in talks for $1 billion plus stake in India's biggest snack maker. In a significant development, Singapore's national investment firm, Temasek, is negotiating to purchase a stake of 10% to 15% in India's largest snack manufacturer. This equity sale could serve as a potential launchpad for an initial public offering, IPO, with insiders indicating that the deal could value the company at approximately $11 billion. Attracted by India's rapid economic growth, global investors are increasingly turning their attention to the country, making it a hotbed for transactions. The managing director of Temasek's India investments noted that the firm has invested nearly $37 billion in India over the past 2 decades, a figure that is expected to rise significantly. Last year, the company announced plans to invest several billion more. This news highlights a notable shift in Temasek's investment strategy, as it reduces its presence in China while significantly increasing its investments in India. What was once mere speculation has now evolved into a substantial financial commitment. This trend warrants attention, as it reflects the sovereign fund's assessment of the economic prospects for both China and India. The last news comes from Reuters. EU presses ahead with Chinese EV tariffs after divided vote. In a significant decision, the European Union voted on Friday to impose tariffs of up to 45% on electric vehicles imported from China. This move could escalate into a broader trade conflict with Beijing, which has vowed to protect its companies. Following the vote, shares of European automakers saw an increase. The EU's executive body, the European Commission, is now set to enforce these tariffs, which will remain in place for 5 years. According to insiders, the voting results showed that 10 countries were in favor, while Germany and 4 other member states opposed the decision. Additionally, 12 countries chose to abstain. This decision follows an investigation that found China has been unfairly subsidizing its automotive industry. Beijing has denied these allegations and threatened to impose tariffs on European dairy products, brandy, pork, and the automotive sector. The EU is actively working to reduce its dependence on China. Former European Central Bank President and Italian Prime Minister Mario Draghi warned last month that state-supported competition from China poses a threat to the EU and could make it vulnerable to coercion. I have 2 points to share regarding this news. First, China has exerted considerable effort to try to sway the EU's decision. The outcome of today's vote indicates that these efforts have largely failed, reflecting the EU's determination. Second, when examining the voting dynamics, it's essential to recognize China's influence within the EU and its potential to create divisions. Alongside Spain, Germany voted against the proposal. Without France's firm stance, there could have been greater concessions to China. International politics can often be complex and nuanced, defying simplistic interpretations. While we may typically view President Macron as someone who tends to make grand statements, in this instance, China focused its retaliatory efforts on France, and Macron did not yield. The voting results suggest that if China were to intervene in other matters, its influence could still be quite strong, given that there are political factions in Europe willing to align with Chinese interests, whether they are seen as useful idiots or otherwise. That's all for today. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more updates. I look forward to seeing you in the next one.